So again, my name is Kelly Milligan, managing partner with Quorum Private Wealth. This is the Quorum Forum. Today we're discussing Code Section 1031. You might say, boy, why do I want to spend time studying some obscure part of the tax code? And what's so neat about this is it shows you how there are professionals that deal with these sections of the tax code every day in their professional lives, and it can really be a benefit for the people who know how to take advantage of them. So we're going to unpack this code section 1031. It's particularly advantageous to property owners and prospective property owners. And let's get started. So let me first make some introductions. To my right is Teresa Flugel. Teresa is an executive vice president at Chicago Deferred Exchange Company, a wind trust company. Chicago Deferred Exchange provides qualified intermediary and exchange services nationwide to clients using Internal Revenue Code Section 1031. Teresa is a certified exchange specialist, brings more than 25 years of experience in the field. So she works with accountants and attorneys and realtors and investors and of course financial advisors. So thank you. And all on the subject of 1031 exchanges. So welcome, Teresa.
Thank you.
Then we have Miguel Aguilar. So Miguel is a vice president with Ares Real Estate Exchange, which is a division of Ares Wealth Management Solutions. Ares was founded in 1997 and manages $428 billion from their 35 global offices. They are one of the largest alternative investment managers in the world. So Miguel assists his clients with DST 1031 exchanges, which I don't want to steal his thunder. So we're going to have him describe in further detail today. So Miguel earned his MBA from California Coast University and is a chartered alternative investment analyst. Thanks for being here, Miguel.
Pleasure. Thank you for having us, Kelly.
Well, so this is being recorded. I should tell you all that. And we have an opportunity for Q&A. So if you have a question as we're going along, type it into the Q&A section in the Zoom meeting. Hopefully we will see that on our iPad and be able to answer that real time as folks have questions. So let's get started. I'll start with you, Teresa.
Okay.
What is Section 1031? Just start us at the top and at a high level.
Well, Internal Revenue Code Section 1031 allows investors who own investment real estate to be able to defer the capital gains tax on the sale when they sell their investment property. So it's been around, part of the code section, since 1921. So it's been around over 100 years, and there's a lot of benefits that clients can utilize by doing a 1031 exchange.
So this is not new.
It's not new.
Well-established law.
Yes.
And you said taxes deferred. Taxes deferred is taxes saved, right? Because of the time value of money. If you can push off an expense, you get to, not have to take money out of your bank account to pay that tax. That saves you money. Those funds could be used elsewhere in your investment portfolio. So, and then we will get into maybe a long-term potential benefit of 1031 is you keep deferring until you die.
Correct.
And you can tell us all about the joys of that.
Yes.
Okay. Miguel, so who is most likely to use or take advantage of Code Section 1031?
Yeah, absolutely. Well, I think from our perspective here at Ares, our ideal client is going to be someone who wants to go from active management into a more passive role, keep that tax deferral in place. And so that's really going to be the most ideal client. So wanting to get rid of the tenants and no longer having those landlord responsibilities, that is going to be someone who wants to, what I like to call, breaking the fourth wall. They want to defer the capital gains tax, but they want to move from active to passive. And then secondly, I would say from a 30,000 foot view, clients who are looking to have their estate planning affairs in order and simplify that process. And as you had mentioned in initial comments, being able to defer all the way until passing and your estate being able to inherit it, that is going to be the two ideal situations that you'll see people utilize the tax code.
So am I right here? Either one of you can answer this. Primary constituency here is someone who has maybe owned real estate for a long, long time. And if you do that, you depreciate the heck out of it.
Mhm.
Depreciate means that every year your accountant, or you, if you do your own taxes, is writing off a portion of that property because it against the income of that property, because that property ages, its useful life is over a certain period of years, and you get to take a deduction for that useful life. So eventually, what you paid for the property over the course of taking all those deductions goes down, 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 down every year that you take that deduction. So a lot of real estate investors have what we call low basis in property. And the problem is, if you just outright sell that property, your capital gains tax is the difference between your basis and the market value. So if you have this low basis, you have a big tax bill.
Especially in California.
Yes.
Yes, California always wants their piece. Not only do the feds get their piece. So this is the typical person here is long-term real estate folks who maybe want to get out of one property and get into another property for whatever the reason, and have this big impending tax bill that they would like to push down the road.
Yes.
So is it confined to, though, a specific type of property? Yeah.
Yes. So, I mean, a lot of our clients have never done 1031 exchanges before. I mean, we can work on transactions all across the country, large institutional REITs, all the way down to mom and pops. And it requires a lot of decision making, because if you own investment property, you're making a decision to potentially sell the investment property. And then you need to make another decision on, are you going to pay the capital gains tax upon that sale? Or do you want to enter into a 1031 tax deferred exchange? And, you know, we always advise our clients, talk to your CPA who's reporting your tax return, because you may have some losses that might offset that gain. You know, you may have other things in your real estate portfolio and it doesn't make sense for you to do an exchange. And everybody's completely different. I mean, everybody, the rules, the requirements that we're going to talk about are the same if you're an individual selling for $150,000 or if you're selling for $1 billion. The timelines, requirements are the same. So there is a lot of black and white and there's a lot of gray area. But if you're selling any type of investment property that's vacant land that doesn't produce any income, it does not apply to your primary residence. So not Section 121. It does not apply to your home that you live in. So it can be rental condos, houses, apartments, office, industrial, retail, tenants in common with other owners, triple net properties. Basically anything that you go to sell that's not your primary residence is going to be subject to capital gains tax. It's generally about a third is what I tell people. It seems to be a good average. So if you paid $1 million for a piece of property, you're selling it for $2 million, rough estimate, you're probably going to pay about $350,000 to $400,000 in tax. And then the CPA can give you the specific number when you talk with your CPA, but it's a big number for people.
But I said it, I heard it twice. Just want to make sure people hear it in the webinar, not your primary residence.
Correct.
Okay, so that's number one, is not for your primary residence, although there is a tax benefit for selling your primary residence.
Correct.
That's another webinar. And what about your second home? Can you?
It depends on how you're reporting it on your tax return. So if you're reporting it, from what I understand, as a second home, utilizing it as a second home the majority of the time, almost like you're living there, that's how you're reporting it. More than likely, that's not going to qualify.
That's consumption,
it has to be
not an
non-owner
investment.
occupied investment property with the intent of holding it for investment for some period of time. So there's a ruling, 2008, that you can use it 14 days or less, or less than 10%, that, you know, people can.
So maybe
utilize
if you
a little.
primarily Airbnb your second home and you only show up there 14 days or less, maybe that could be considered an investment property, and maybe that, but that's what you guys figure out, right?
That's what their CPA figures
Oh,
out,
okay,
their tax
okay.
advisor. Yeah, we cannot provide specific tax or legal advice in our role as the intermediary.
I mean, this is one of the reasons why we named it from Quorum, is we feel like we're part of a team of people, your Quorum, which includes specialists like Miguel and Teresa, but also specialists like your tax advisor and your estate attorney to help you make good decisions. Everyone has their own little area of expertise.
Yes. And that's why they need a financial advisor to kind of look at the whole portfolio and figure out what people's goals and where they really want to be. And then they have to have experts that can kind of define.
What
Well,
the best
Yeah.
best path forward is.
like you said, there may be capital losses elsewhere in the portfolio. It could be from stocks and bonds.
Correct.
That could offset. So it's not always an immediate decision of oh, we have to do a 1031 exchange. You might give the advice of no, there's other options that you might consider. So if they did want to go down the path of a 1031 exchange, what are the basic steps here? Kind of steps and deadlines.
Sure. So there are some specific rules, right? You have to hold the property with the intent of holding it for investment for some period of time. The IRS requires the same tax reporting entity that is selling the property be the same tax reporting entity to acquire new property.
Okay,
And
so
oftentimes-
back up a second. There. You might have to give an example.
That's a can of worms.
Yeah.
So if the three of us own property together and we're in a partnership LLC and we own this building and we decide to sell, our same LLC would need to acquire new property.
But if I just want to sell my
There you
interest,
go. There you go. So that's where I always tell brokers, commercial brokers, and real estate agents, if you're talking to people that own investment property, it's a good idea to take a look at how you currently hold title and what's everybody planning on doing, because it could be us as business owners together, or it could be family members, and not everybody wants to exchange. And so you have to talk with your real estate attorney about dissolving partnerships into tenancy and common interest. So then when you do sell, you can go your separate way or pay cash. But it is a big issue with 1031, because when you dissolve a partnership or LLC, now you are a new entity as an individual, maybe under your social security number. You haven't filed a new single member LLC, and you may have only held it for a week, 2 weeks. And what does your CPA think about that, or the California Franchise Tax Board?
like this is a brand new entity.
It's a brand new entity. So it's a risk tolerance down to the taxpayer and their CPA. We see them happen all the time. Sometimes people get unsolicited offers, right, for properties right now. They didn't have enough time to go and dissolve the LLC.
Yeah. And I'd also say too, having the conversation early on, even if it's more of just a general educational overview in understanding the tax code and how entities work is, I think, imperative, because we don't want to get too further down the line. Next thing you know, the three of us cannot exit and go our own way. So I think just having that initial discussion, understanding how a transaction would work. And as Teresa alluded to with California, if you were to dissolve the LLC and go as a tenant in common and each individual member had their interest, now California could come back at you. They're very strict with what they call the drop-in swap. So we want to be very cognizant of, those type of tangibles whenever, looking to dissolve or exchange with a partnership or LLC.
I mean, these are the kind of nuances that is exactly why we circle the wagons with you guys.
That's why you're like, time out.
Yeah, and look, if you've heard some terms like drop and swap and what's that, we're not going to go into it. That's their expertise. But I think the takeaway message here is, if you're a property owner with a significant capital gain and you're considering exchanging or using this code section, the earlier you can start the conversation, the better. And that way it gives us a chance to circle the wagons with all of your trusted advisors and make sure that we're following the right path. Okay. So now there's like a 45 days.
Yep.
Can you talk a little bit about deadlines?
So what happens is our role is a qualified intermediary. So we're going to be preparing documents and we're going to be holding the funds. And we have to be involved prior to the close of escrow on the sale of the relinquished property. If you as the client, you take the proceeds, you have constructive receipt of the funds, you cannot do an exchange. So sometimes it can be a little bit challenging for people to think. They may think that they file this on their tax return, their income tax return. They don't always realize that the third party qualified intermediary needs to be involved under the IRS regulations in order to defer the tax. So we get involved, we coordinate with you, with the client, with their advisors, with their escrow officer, and we are going to be coordinating documents for them to sign prior to closing. Once you officially close escrow on the sale, the funds come into the exchange. We send verification of funds received with the critical dates. So the IRS gives you a total of 180 calendar days, which is 6 months, to purchase new property, but you have to identify the property within the first 45 calendar days. So weekends, holidays all count You can change your mind as many times as you want during the 45 days, but ultimately you have to be able to acquire the property, one of the properties or all of the properties, that you identify during the 45 days by day 180 in order to have a valid exchange. And so you can change your mind as many times as you want during the 45 days. One key element here that I'll kind of wrap up this part is if you want 100% tax deferral, is that you want to purchase property that's going to be equal or greater in value than the sales price of what you're selling, not just your net proceeds. So it's the sales value and the cash proceeds that come into the exchange need to go into the new property. So if you purchase property of lesser value, take cash out, have cash left over, or you overfund your loan and walk away with any cash on the purchase, you will have some taxable boot, which is okay. You just need to be aware of the fact that you're not doing 100% tax deferral, and that's totally allowable. So, and you want to talk about property rules?
Well, I was going to also add to with the full tax deferral, if a client has a loan on a property and that loan gets paid off at the time of closing, keep in mind that loan needs to be quote unquote replaced in whatever you acquire next, directly, a DST. So if you sell $1 million of real estate and there's a $200,000 note on it, 800,000 would go to Teresa, but the IRS still requires you, well, 200,000 goes to pay off the loan, but the IRS is still going to require to acquire at least $1 million of real estate. So many people think, well, I paid off my loan, I don't need another loan.
It's very common. And you can make up the debt difference with cash out of pocket or lender financing or a combination of both. So sometimes people, they may not want to fully replace the debt. They'll bring in their own cash, which is allowable.
And property identification, replacement property identification within 45 days. I want to circle back to that because I think that is, correct me if I'm wrong, is a real advantage of DST offerings because they're kind of always on the shelf and it's like, oh, this property is available right now. Here are the terms and conditions on it. And it's might be easier than saying, oh boy, I'm contemplating sale of this property and now I got to scour the country for some property. I don't know where it is, what it is. So let's talk about that. Let's circle back to that. Before we get there though, Teresa, maybe you could take us through kind of what are the most common types of 1031s you see?
Well, it's a great tax deferral, right? And then it's a great benefit if people are looking for greater appreciation. They may be looking for greater cash flow as they're getting older. They may be looking for something to retire into at a later date. They may want to consolidate smaller properties and go into a larger property. They may want to sell a larger property and go into smaller properties. You can exchange anywhere in the US, any type of property. Sometimes we see folks here in the Bay Area buying homes for their adult children to live in if they're having kids and they want a better school district. Sometimes we see some of that.
And the kids would be renters.
Yes,
so that's
the kids would be renters. Yes. Every client is so unique and different. And if they're business owners, a lot of times people will get SBA financing, buy a building, and then they'll exchange into that building. So then that way they can run their business out of it. So it keeps it interesting for so many years because there is a lot of different things that people can do. And they don't always realize that they can exchange out of vacant land and exchange into something that does produce income. So there's a lot of great benefits to it. And we kind of touched on it earlier. At the end of the day, it comes down to estate planning. So hopefully you're working with your advisors to set up your trust and set up your will and do your estate planning because ultimately your heirs would inherit the property and then they get a stepped up basis. So, I mean, it just taking the time to do all this and understand it. I mean, it's just really great for families and businesses.
Yeah, we're going to circle back to the step up in basis as a real advantage of this. Before I get to Miguel, because I want to spend a lot of time on DST, I think that's really fascinating. Triple net properties. Do you see a lot of, first of all, what is that?
Yes. Okay.
And then why is that attractive?
So what happens is we see folks that have rental houses and then they move into apartments and then they have apartments for a while. And then the folks that own apartments tend to go into triple nets. Like they may want a Starbucks or maybe a Walgreens or a CVS where they still want to kind of have that hands-on, hands-off. I want to see my real estate. I want to touch my real estate. And
but I don't want to collect from 100 different renters.
Right. So those are very popular, but it's all over the board though. I mean, it really is, it's just understanding the mechanics of how it works. And we're always talking to people and going through different scenarios on what they want to do because Yeah, there's lots of stories to share. So
Yeah,
I could
every
talk all day.
client's different, for sure.
Every client, every single one is very different. Yeah. Mhm.
Yeah. So Miguel, I want to spend some time with you on DST 1031s. First of all, what does DST stand for, and
Yeah.
why is it so unique and a powerful tool?
Yeah, so it stands for Delaware Statutory Trust. It has been part of the tax code, I guess you would say, for the last 20 plus years. It has its own Internal Revenue Code ruling 2004-86. And when Teresa had alluded to earlier about what properties qualify under the 1031 tax code and what the IRS deems eligible for exchanges, right? It's nearly everything else under the sun, right? Except for your primary residence. The DST itself qualifies under that like-kind rule. So in the event that a client does a 1031 exchange into a DST and is ever audited, it would hold up.
So give an example, say an Aries case.
Yeah.
What would be in a Delaware Statutory Trust 1031? What kind of property would you be exchanging into?
Yeah, absolutely. So our portfolio of real estate is pretty vast and wide, but I would say today, the two largest conviction sectors that we look at are multifamily and industrial distribution warehouses. So think of the DST as really a mini portfolio of real estate where you have multiple properties within it. And all we are simply doing is exchanging and selling daily interests into that trust. So as a client goes through their 45 days, they identify the real estate within the DST. Cannot be the actual DST name itself. It has to be the actual physical real estate addresses. So something to keep in mind. And then as they exchange and finally close, and Teresa and her team wire over the funding and we close their interest, they have basically gone from being an active landlord to a more passive role. They own a beneficial interest in this passive trust. They are compliant with their 1031 exchange. And I mean, I think above all else, they have now put themselves in a position where they've deferred those capital gains, but have achieved their goal of going to a more passive, non-landlord responsibility type role.
So one flavor of this 1031 is you own property, you decide, hey, I want to make a change. I'm going to swap it into a Starbucks. Starbucks makes rent payments to me, but I'm still a property owner. I gotta, I gotta look at that property and I can go kick that property and, it is my property. You're still a property manager. This DST flavor is basically you want to exit the property management business.
Correct.
And so what you're doing is you're taking your property, real property, you're selling it, meeting all the deadlines, making sure you get a qualified intermediary and all the deadlines and rules. You're selling it, you're taking the proceeds. First, you're going into a property that Aries has identified.
Correct.
That Aries wants to add to their gigantic portfolio of properties.
Correct.
So you own that specific property.
Correct.
For a period of time.
Correct.
And then after a period of time, usually is it
2.5 to 3 years, let's call it.
2.5 to 3 years, then Aries buys that property, adds it to the portfolio, and gives the former property owners back shares of your fund, a security.
That is correct. So we are a little bit unique in that sense. And so we utilize obviously the 1031 part of the tax code initially, and then eventually we'll utilize a different part of the tax code called a 721 exchange. Not many people are very familiar with 721 exchanges. In theory, it is a simple pledging of real estate to a larger real estate investment trust versus to a partnership. And as opposed to receiving cash for the transaction, the client receives partnership units and is now a limited partner within that partnership. And that is simply what we're doing. We like to position ourselves as more of an end goal strategy where those proceeds will eventually be working for them in a much broader underlying diversified pool of commercial real estate. And by doing so, they now become a limited partner. They have partnership units. They are subject to the performance of the real estate. They have access to a potential redemption program subject to some guidelines. But the uniqueness here is that you're essentially mitigating market and tenant risk because now you're going from, what would be the initial property that they sold where it's a rental, let's call it, one tenant moves out, right? You have to re-tenant and has to begin cash flowing again. Whereas you go into a much broader pool of real estate, there's no essential domino effect if a tenant does not renew across a $1 billion plus portfolio.
Yeah, you're going from being a property manager and everything that entails to a security owner, basically.
That is correct.
And the management of this property is delegated to Aries and their professional management team and all of the resources that that organization provides.
Correct. And I would also say too, because that 721 portion of the tax code that we utilize, with our program is very unique in the sense that a client would not be able to 1031 exchange out of it. So very important to mention is that, if you were ever redeem, you cannot on a tax deferred basis put that into another investment
So
property.
it is the last stop.
It is the last. It is the last stop. Yes, it's the end of the line.
Whereas many of the 1031s that you do, you go from your rental property to a Starbucks, and then you could decide, oh, I want to go from a Starbucks to an office building.
Correct.
You can keep going.
Mhm.
Okay. All right. Well, that's certainly an important distinction. Yeah. Let's go into a few case studies. Maybe I'll start with you, Teresa. Could you describe a client, you don't have to tell us their name, but a client who has used 1031 and what really were the advantages they saw? Like what drove the decision for them to use 1031?
I don't know that there's a particular case study because I think that, you have your real estate investors that are, developers that love real estate and they're always looking for a better deal and they're always going to be exchanging all over the country. And
So they might be shopping jurisdictions, like tax jurisdictions. Like I
Yes.
want to get out of property in
Yeah.
California and go to Nevada.
But you got to keep in mind, there's a form out there that when you exchange outside the state of California and you do an exchange into another state, California, your CPA is going to be filing a form every single year until you sell that property. And if you sell that property and you don't do an exchange, then they're going to want their claw back here in California. So, that's always hard to, I don't know that there's really a way to escape that other than keep exchanging and your heirs inherit it. But really making the investments work for you and your family or your business. If you're going to be buying a building and, you own it for a while and then you need a larger facility, we see people that will, it's a great tool for them to be able to acquire the new property because we do two things. We do forward exchanges when clients sell and they buy. We do reverse exchanges when they buy first and then they sell. And then there's a lot of clients, to your point about a case study, that like to do improvements to property. And the only way you can do improvements to investment property when you're doing an exchange is through a parking arrangement, which is where if you sell this building for $1 million and you want to buy another building and you want to do improvements on it, and say that building's 800,000, right? You would take 800,000, buy that building, we park it in the exchange, and you can spend your remaining 200,000 doing improvements within the 180 days.
And that's considered
So
still deferred.
It's still deferred. So
Okay.
we do have people that buy property with the intent of making it better before they are able to potentially move their business into it. But a lot of people really appreciate the fact of being able to defer the tax.
Yeah. So many
And-
iterations. of
Yeah,
this.
yeah, and if they're working with their families, there are holding periods with related parties. So if you have your parents, your children, your siblings, there's 2-year holding periods. They don't want to see a related party walk away with cash at the end of the day. So if you have people that are identifying their parents' property with the intent of their parent continuing to live there, like the scenario we talked about earlier, that doesn't necessarily work because at the end of the day, the IRS doesn't want to see one of the related parties walk away with cash. So they've, there's some certain things where they've kind of tightened up different areas, but we do talk to clients a lot about related parties.
You really have to talk through what is the intended use of this.
Yes, and
who is involved.
Yes.
Yeah. Yeah.
But there's so many great cases of people being very happy with doing the exchanges.
Yeah.
But it's the timeline's the hard part. And that's where the DST comes in as a backup. A lot of times, even if that wasn't their original intent, they will use that as like, okay, I'm hoping to get these two. And if that doesn't work out, I want to make sure that I've lined up enough DSTs to make my exchange deferred because they don't want to pay the tax. And
that's really the advantage of the DST is the property is ready to go.
It's ready to go.
And identified. And if you're like, hey, we thought we could get these 2 buildings over here and over here, and they both fell through. the last minute,
Yeah.
you can write in the name of the DST.
By midnight on the 45th day, not the last minute.
Not the last minute.
Yeah,
but-
because day 46, it becomes read only.
Yeah.
So
Yes.
you are correct. I mean, having a DST even as a backup, if your objective is to still go into a direct piece of real estate, having it, you should never go into your 45th day without at least looking at a DST as a backup.
Yeah, early planning,
Yeah.
always best in most circumstances in life. But Miguel, maybe you have some examples. I mean, last minute fill in the blank is probably not the most common use
No,
of
it's not
DSTs.
most- Yeah, of course.
What would be an example typically of someone who might use your approach?
Yeah, again, I think it kind of goes back to going into a more passive role, right? So we break the fourth wall. Many clients today are not familiar that this type of securitized investment is available through you and your team. They think that their only three options are selling the property, paying the taxes, selling the property, doing another exchange, but they want to be out of the landlord business, or their third option is just kind of staying put, right? They didn't meet any of their objectives. But we provide that fourth wall where we can now allow them to go from active to passive, defer the capital gains tax. And I think we're seeing that with a lot of clients who are getting up there closer to retirement. They don't want to deal with the landlord responsibility anymore. And more importantly, they just want to set themselves up in their estate, their kids, their grandchildren. They want to set them up and simplify it. So I think the unique thing about what we do is really provide that solution, that optimal alternative. And then when you look at the estate planning portion of things, right now we're entering the largest transfer of generational wealth we've ever seen. And with that, the estate planning is very crucial, right? I mean, imagine what happens when it comes to inheriting a property when it comes to siblings, right? Three of us, if we inherit it, are we going to be on the same page? Yes, we received a step up in the basis at the time of inheritance, but what if the two of you want to sell and I want to continue to manage the asset? Whereas we provide a solution where those partnership units are fully divisible. So if mom and dad left it 33% to each of us, at that point, we could take our portion, have full control over the third, move forward with the step up in the basis, and individually have full control on our destiny and what we would like to do moving forward. So we're seeing that being the biggest case study across the ideal client that we do see.
Yeah, I think it's that flexibility and individual liquidity potential that owning securities provides.
Correct.
That can really be an advantage here. I mean, if you are, mom and pop, and you've owned a property in your family for 60 years, and then you pass it on to your kids kind of have to be in agreement of what to do with that giant piece of property, and they all have to be together on it. But if you've already gone through this DST process, you don't own a piece of property, you own securities. It's just like owning 100 shares of IBM. You could go a third, and you've divided those shares. It becomes very easy to navigate the process of getting assets to beneficiaries.
Exactly.
Quickly, divisibly, super easy. Well, so this is, I mean, you guys are amazing. Obviously specialists in your field. So let me see if there are any questions here. And I'm going to thank you. Thank you. My partner Sue is manning the question booth here. And if we do get any questions, hopefully they'll appear and I'll know how to retrieve them. But while we're waiting, I do have a question for you. Maybe you could go into more detail about the end game of all this. You defer, and then you die. What happens?
Well, the general understanding is you're going to get a stepped up basis at that time, right? So, I mean, you'd be working with your estate planning attorney and your tax advisors, on what that's going to look like for the family that inherited it.
So the idea of pushing out a liability, that's, taxes deferred is taxes saved. But ultimately, if you die, all of that tax liability goes away, right? I mean, in many cases. And so,
as long as it's set up correctly in a trust and not just out there and may have probate or something like that. I mean, I think that would be a really interesting webinar to have the probate attorneys talk about what they see.
Another
how people hold
reason,
title.
another reason to bring in the quorum and make sure that
Yes.
you're coordinating all of this with your state attorneys.
Mhm.
But I mean, that can be a really, really powerful tool to not only save taxes, but ultimately avoid taxes if you can get to the end of life and have everything stepped up. We did have a question come through. So Miguel mentioned a 2 to 3 year waiting period between identifying a property and putting it into the DST. I'm not sure that's quite what it was, but we can explain. Can he provide more detail about that? What happens during that period? And thanks so much for putting this on.
Yeah, absolutely. So our DST, our expectation is to have that whole period be for about 2.5 to 3 years for our individual investors. And during that time, they would be receiving income.
So wait a minute, back up. So someone sells their property.
Correct.
They use a qualified intermediary. So it's all legal. You've met all the deadlines. You've identified that you want to go into the DST.
Correct.
First step is Aries has identified some property that they already want to put in their gigantic portfolio.
Correct.
So you're not exchanging into the Aries security fund.
No.
You're exchanging directly into a property.
Correct. You are exchanging into a number of properties within this DST that we have created.
Okay.
So
you're an owner of that property.
You're an owner, you're a beneficial interest owner of the entire trust itself, and you are collecting a distribution off of that rental income within that DST. And so there's income that gets paid out quarterly. Our whole period is what we expect, no assurance, but to be somewhere in the neighborhood of 2.5 to 3 years before we execute and utilize the 721 portion of the tax code to go into the broader partnership.
So you own that property for 2.5 to 3 years.
Correct.
And then Aries says, oh, just like we thought, we want that property.
Correct.
We're going to bring that property in the portfolio and bring out shares of the fund.
Correct.
And now you own shares of the fund.
That's correct. And
Okay.
the 721, keep in mind, it is a tax deferred transaction. So there's no tax liability going from 1031 to 721 at that time.
Okay. So during the 2 to 3 year period, you collect rents.
Collect rents.
And who pays those rents?
Our tenants. So if it's a multifamily asset, right, the everyday average tenant, or an industrial property, for instance, the Amazon and e-commerce, necessity-based logistics type tenant. These are the type of tenants that we are working with that are paying their monthly rent, and then all of that just flows back to the end user.
But ultimately, Aries is going around collecting those rents.
Correct.
Like you don't have to go knock on
handle
people's doors and
everything.
break kneecaps.
That is correct.
Okay.
Yes, and our whole focus is core real estate. So core, built, leased up, income producing real estate. There's nothing opportunistic about what we put in our 1031 exchange program.
So as soon as you enter this DST program, from the very inception, you are out of the real estate management game.
You are out of the real estate management game for good. Yes.
Yeah. That's why it can be such an important tool. If you want to stay in the real estate management game, there's tons of options out there with huge tax advantages. Just depends on what you want to accomplish.
And the other thing I'd like to mention about DSTs, because they are ready to go, right? We find clients that will exchange, funds come into the exchange, they already identify the DST and they are already redeploying their equity and earning income within a day or two, because they're able to close quickly. Where sometimes when people go, they're having a hard time finding property during the 45 days, they're not getting cash flow from their existing investment because they sold it. And then they're trying to find something, which may also have another 30, 60 days. So sometimes people do find the DSTs beneficial for that reason, to redeploy their equity sooner.
And we've got one more question, but before we get there, is it possible to do a combination of these? Like, let's say I'm like, hey, I love that Starbucks, but I also like this DST. You can do both.
You can leverage up as much as you want. So the goal is to buy equal or greater if you want to defer all the tax, but you can leverage up as much as you want and diversify. Now, there are property rules we didn't talk about that you could identify up to 3 properties anywhere in the US. If you want more than 3, which is very common with the DSTs, you cannot identify more than 2 times the value of what you sold. It's known as the 200% rule. So if I sold for $1 million, I could identify 3 properties, each at $1 million, no problem. But if I identify a 4th property and I go over 2 million because I sold for $1 million, there's timeout there. The IRS does not want somebody to go out and identify 50 or 100 properties. So it's either 3 of any value or under the 200% rule.
Okay.
And the 200% rule is very common with DSTs. So
Okay.
they can get more properties.
What are the downsides of DSTs? That question came in.
Yeah, I mean, downsides. I think just giving them active control, I would say, is the biggest downside. And I think it's important to understand who the sponsor is, how long they've been doing this. DSTs are extremely prevalent. I mean, the industry just 2 years ago did well over $1 billion in equity. I think just understanding the player, the real estate, the market, the experience of the actual acquisitions team, underwriting, due diligence, all those things are coming into play because essentially you are buying real estate. So that's really the biggest downside, is just making sure you do a very thorough due diligence and understanding of who you're putting your dollars with.
Yeah. So if you're in a non-DST 1031 exchange and you decide, you know what, I just want to, I've done my exchange. Now I want to sell. Well, you deferred your taxes up until then, and now the tax man cometh. Now your bill is due for capital gains.
Okay.
So you can sell anytime you want. There's just a tax consequence.
Yeah, whenever you
doing
sell
that.
and you don't exchange, you'd have a tax consequence. And
Yeah.
to his point earlier, I will mention the qualified intermediary industry. You know, we've been around a long time, but the industry is still pretty much unregulated. So you want to make sure that you're doing some due diligence on your qualified intermediary to make sure that your hard-earned equity is going to be there when you go buy replacement property. And, you know, that has not been the case in 2008, 2007. There are a lot of Ponzi schemes that are out there. And, you know, very passionate about that. I mean, we've been in business over 35 years. We're bank owned. We're owned by Wintrust Financial Corporation. We're in their wealth management division. We're a qualified intermediary, Chicago Deferred Exchange. And, you know, we go above and beyond what the IRS requires. We create a separate trust for every client, every transaction. Doesn't sit on our balance sheet. It means something to our clients. We pay interest to our clients. You have a lot of pop-up intermediaries right now that are kind of coming out of nowhere. And when I talk to, you know, escrow officer friends, they're like, oh, I don't know where these people are finding these people. Well, they're probably finding them on the internet. So it's like, you've got to ask your CPA or your attorney, you know, ask some more questions, you know, to know who you're placing your money with, because it could be there for, you know, up to 180 days, but you want to make sure it's going to be there when you go buy the property. Because sometimes people are really consumed with selling, buying is now the right time, looking at cash flow, looking at DSTs, and they're forgetting, oh, wait a minute, where they assume it's with the title company. They don't know that the intermediary is a third party, almost like a middleman that comes into the transaction to prepare documents on the sale. And we're working with them all the way through until they complete their purchase. But
I'm sure qualified intermediaries are kind of like buying sushi at the gas station. That's not where you want to save money. You want to get, you know, a quality person. You're not saving money by shopping your heart surgeon.
It's a transaction. I mean, for a professional service provider. Yeah.
So we talked about, you know, if you exit 1031, the tax man cometh if you sell your property. What about exiting a DST? So let's say you're 2 to 3 years into this and you decide for whatever reason, I want out.
Yeah, there is no liquidity in the DST. And that is standard with any DST. So whether it be Ares or any other vendor, there is no liquidity. You have to look at this as an illiquid real estate investment. And so it is deemed, the liquidity is deemed when it's time to actually sell the DST in the traditional sense. So let's say a traditional vendor may hold it for 5, 7, 10 years. When they sell it and the proceeds come back, then yeah, there's liquidity there potentially. With Ares, there's no liquidity during the DST phase. And then once
that 2.5 to 3 years.
Correct. And then once we're in the broader partnership, then you can access our redemption program.
So meaning that when you get out of owning the individual property and now you own shares of a fund, a security, like any other security, you have redemption provisions for selling that security, and people can get out partially or fully as they wish.
Exactly. Subject to our guidelines in our redemption program, absolutely. And that's a unique, that's a nicety that it's an option. It's not mandatory. It's at a client's discretion.
Okay. Last question. This is a pretty general question. Any downside risk related to liquidity or return? You talked about liquidity issues during the DST period, 2.5 to 3 years. Any downside risk? I mean, certainly related to return. I mean, property is
Real
not
estate,
a
yeah.
CD. It's not
Mhm,
bank
mhm.
guaranteed or anything.
Yeah.
It's the risk of owning real estate.
It's the risk of owning real estate. I think you just got to understand where you're putting your dollars. Again, going back to asset selection, where the best use of those proceeds are today. We're a core investor. So when we look at the opportunities in the market, we are fairly optimistic, but there are some headwinds that come with any sort of real estate investment. So absolutely, I think it's important to understand that there's always going to be that risk reward and that spectrum on where your dollars deem fit, whether you go out and buy a direct property or you utilize an Ares solution.
I think that question is probably less about 1031 exchanges specifically, and more about what are the risks of being a real estate investor.
Right.
Yeah.
And it is a function of what kind of real estate you're investing in. If you have an apartment building, your risk is tenant doesn't pay you, or who knows, your apartment building catches fire or something.
Right.
If you own a Starbucks could go out of business, or coffee causes cancer or something like that. I mean, you don't know what happens there. One thing that the DST helps with is it diversifies your risk across how many properties you guys own?
Yeah, I mean, north of a few billion. So absolutely, yeah. I mean, we mitigate risk, right? We obviously we're not
eliminating risk.
Eliminating risk, but yeah, of course. I mean, again, if a tenant doesn't release their space and they move out, it doesn't have a domino effect on the rest of the portfolio in that situation. So absolutely. I mean, again, if we compare that to a client who owns a property and a tenant moves out and they can't re-tenant that for months, again, you're not cash flowing.
Right. But it's like the same advice we give in portfolios as stocks and bonds: diversification. Benefit.
Yeah.
So, all right. I think we've had a great discussion. So thank you both. This has been fabulous. Again, so happy to have two real experts in this field, and so important to emphasize that the earlier you can start the discussion with us as financial advisors, we're happy to quarterback the team and bring in all the resources for you, or reach out to the qualified professionals that if you're contemplating a transaction like this. But I hope this has been helpful. I found it very educational. I appreciate both of you. And that'll wrap it up for this episode of the Quorum Forum. Thank you for tuning in, and we hope to see you all soon. Take care.